Welcome to video number 4. Can you really guarantee your exit? Well, the answer is yes. You can actually lock in the price at which you will sell, the lowest price at which you would sell, before you even buy a stock. And you can do that by buying what's called a put option contract. Here on my website, www.radioactivetrading.com, I give out a free newsletter that details that particular strategy at work every single month. We're going to take a look here at a page here called the sketch, and then the overview of the radioactive profit machine, or RPM for short. Radioactive profit machine strategy. It's simple. Number 1, you buy the stock of an optionable company with high accelerating earnings, and you couple it with an in-the-money put option several months out, 5 or more months out. Now, if you're new to options and you don't know what in-the-money means and you don't know what put means, there's several free resources available on the web. Of course, you can buy my book, but I'd like to just let you know about this process. This is what will keep you from going broke. Okay? Step 2. Use one or more of, it says 4, but now there are 5 income methods to pull money out of that stock and option combination between the purchase date and expiration. Now, when assembled according to the detail that's provided in our flagship product, the Blueprint, money management is built in. You can set it up so that no single trade carries any risk greater than 5%. And I'll show you some examples of some closed trades in just a moment. When the income from a trade exceeds the original risk that's taken, an RPM, radioactive profit machine, is called bulletproof. That is, it can still gain in value, but it cannot lose, period. Now, risk management is what I call the only real holy grail of trading, and the put option is the only risk management strategy that works for all markets. For example, a stop order tells your broker to sell if a stock falls below a certain price. It tends to shake holders out at the worst possible moment. This has happened to me. Do you want to pick the low price of the day for your stock? You set a stop too close and you'll see your stock get called away at that price and then rise immediately. I'm not kidding. This has happened to me more than once. The diversification strategy is another way of mitigating risk, but it doesn't work for most individual investors. You see, you have to buy lots of different kinds of stocks in different sectors. It lacks focus, and it really lacks effective protection against a large-scale market turndown. As far as limiting your profits, well, one sector may be rising while another falls. It cuts your gains. And if they're all falling, if you have a major market turndown, you're just out of luck. Diversification doesn't work. Only a put option guarantees a stock's sale price before a certain date. It's still considered a bullish strategy when it's coupled with stock ownership. It's interesting. Large institutions use them all the time. In fact, when there's large amounts of put option purchases, that is a bull signal because they're holding their stocks in anticipation of an upswing rather than selling their stock and raising cash. The big boys use my strategy, but sadly to the players in the market that could benefit the most, the married put and the income methods are unknown. That player is you, the private individual investor. Don't take it from me. See it to believe it. You can have trades emailed to you in real time, but I'll caution you to understand that this is not trading advice. I don't give financial advice, but you can certainly look at the trades that I'm doing in real time and see whether or not the system works. Let's go ahead and take a look at the View Trades page on radioactivetrading.com. And I wanted to take a look at some recent ones. Let's look at Priceline.com. I don't know if the resolution on your screen is going to support this, so you may want to just go to the site. But here we have on December 22nd of 06, bought Priceline at $41.70 for the stock, and at the same time bought a put option clear out to July for $5.60. That guarantees that I can sell that stock for $45 a share anytime between now and July, but I don't have to. I'm under no obligation to do it if I don't want to. Now today, the total investment there was $47.30 per share, or $4,730. The guaranteed value is $4,500 for those 100 shares. So the at risk is really only the difference, the $230 difference, about 4.86%. Today's price for Priceline, well, it's risen a little bit. We're at $51.87 a share, and that put option that I purchased is still worth something also. You see, it'll tick down as the stock price ticks up, but it won't tick down as quickly. At this point, we have a situation where I'm going to want to make this stock bulletproof by doing one of the 5 income methods. Let's look at something just beneath it here, though. OmniVision. OmniVision's a trade I got into March 22nd of last year, and I had $187 at risk per share, or per 100 shares, or a maximum of 5%. Now, something happened where I used my income methods. I used income method 3 and income method 1 to get out of this, but we had a 3.6% gain instead of a loss. Here's what the chart looked like. This is an email that I sent out. Looky at the chart. You know, some folks are out there doing a very risky strategy called selling covered calls, and this stock was a good candidate for selling covered calls. I didn't sell covered calls with this stock. I got in and bought the stock and bought a put option to guarantee my sale price. I ended up getting out of it, even with a chart like this. I bought it around up here, $28 a share and change, and I got out as it was taking its plummet. I could have even gotten out today and still had a 3.6% gain. Pretty interesting. Let's go back. Wanted to look at Akamai. Akamai was actually a stock that was picked by one of my subscribers, not me. But we got in July of 03, and just a little bit later we were what's called bulletproof. Had made enough money from the income methods in the stock that it totally canceled the risk, and it was left open to where it could go up from there. In just over 3 months, we got 10%. The total that was ever at risk in this trade was 4.2%, and then we gained 10%. Do you remember that from the Excel spreadsheet? If you're able to limit your losses very, very low and leave your upside totally open, you can have trades like this. Lockheed Martin was another example. ValueClick is now bulletproof. Later, here's Cognizant Technologies. Just closed that today with a 12.5% return. I never had more than 6.9% at risk. So anyway, these are some other just things that I show on the site. You know, as I get into a trade in real time. For example, got into Google, and then you know, about a month later we. Well, actually 8 days later, we were bulletproof. We made it so that Google could still gain, but it couldn't lose. Diamonds, the Dow Industrial Diamonds here, which is an interesting stock. It also pays dividends, but I can use one of 5 income methods besides the dividends on it to pull money out. We made it bulletproof shortly after buying it. Again, bulletproof means that you've actually canceled whatever risk there is in a trade to where it's zero. Can you imagine the Excel spreadsheet with a 0 in the loss limit side and just infinity in the gain side? Well, that's it for video number 4, and I'm going to bring you to video number 5 here, where I'll just make an offer, and would really like to see you become part of the community that's doing this new kind of trading. It's really not new. It's just new to many individual investors because the institutions have been doing it for decades.